Welcome to the big show. It's the Retire Young radio show. If you're a first-time listener, thanks for stopping by. I am your host, Joshua David, and we are happy to have you with us today. Once again on the program, I have my great friend, my great pal. He is the mastermind of this whole operation, Mr. Al Connickson. Al, how the heck are you doing today?
You know what? I am doing so well that if I did any better, it would have to be doing something illegal, and I don't want to go there.
Well, summer, is it technically over now?
Yeah, we're heading into fall.
We are. It's a little chilly out there, but we got some better weather coming. But it is always great to be back, helping our Retire Young family make those better investing decisions. Today we got another packed show as always. We're going to talk a lot about the current market conditions. We had another phenomenal week in these markets. The S&P was down 2.5%, the Dow was down 1.6%, the NASDAQ down 4.6%, and everybody's probably wondering, why is that such a great market?
What are you talking about?
Well, that's what we're going to discuss today, Al. We're going to talk about really how to help people become more financially literate because, there's a lot of opportunity right now in these markets. So, Al, let's start with that. Let's break down these markets, what is happening, and let's dissect why this is such a great market, even though it's been down.
Yeah, okay, well, let's talk a little bit about the market. The S&P 500 was down 2.5% for the week. That's a back-to-back weekly loss, and the first time it's done that since early March when the COVID pandemic was kind of nearing its peak. And then for the NASDAQ, it was the worst week ever since, or not ever, but it was the worst week since March. So how are we saying that this was a good week? Well, we always talk about these markets. It doesn't make any difference which way the market's going, whether it's up or down. Those can be great opportunities if you know how to take advantage of them. And I think that what we're seeing right now in this market, and the reason we're seeing such big movements is the market, the one thing the market doesn't like, in fact, it despises, is uncertainty. What is there to be uncertain about right now? Well, how about the election? Who's going to win the election? What will the impact be? What about the vaccine? When will we get the vaccine? Will it be safe? Will it work? What about China? Has this market come too far too soon? Can the economy catch up and help justify these high valuations? Some of these stocks are in nosebleed sections there. Well, we've talked for many, many weeks now about urgency, about the fact that you don't want to put off learning how to do this. If getting your arms around your financial situation, whether it's to generate additional money now or to build wealth for your retirement years, don't put it off. And we're seeing the impact now of what happens if you don't know how to take advantage of all market directions. This market has been really almost in some ways unhealthy for some people because they're so used to just having the market go up. That's what they know. They put money into the market and it goes up. This last week, the market decided to teach people a lesson and pulled back significantly. So there were people that were benefiting from that. There are companies that make probably their best returns on big down days or big down weeks like this. So putting this off is something that you might want to rethink. And be honest about it. If something is important enough to you, you're going to find time to do it. So it's up to you to decide if your financial well-being is important enough to maybe invest some time into learning about. And then the other thing is controlling emotions. And when we see these market moves, especially when it goes a direction you're not used to, emotions take over. That is the biggest enemy to anyone who is going to be a trader or investor. And protection. We harp on this every week. Having protection, making sure that if the market does go a different direction than you are positioned for, that you are aware of that can happen, and you have a risk management strategy in place that will protect you.
Well, that is the key, Al. A lot of people just don't know how to protect themselves. You have to have the proper risk management, and that some people are afraid of that word. Well, let's embrace that word. Now, there's ways and there's opportunities where you were talking about these down markets, and I want to get into that in the next segment, but it's called shorting. And shorting in a nutshell is just as markets go down, us as investors, we can participate in a positive way that way. So I want you to dissect that in the next segment, but also in the retirement, when we talk about retirement coming up in the third segment. But, you talk a lot about, we always talk about financial literacy. Us as humans or the public or even America is not financially literate. So we've been helping a lot of people just understand how these financial markets really work, how the stock market really works, how our retirements work. So Al, in these investing classes that you teach every single week, you really dissect that. You talk about how it works, how supply and demand works, which we're going to discuss coming up here as well, but really how us as investors can participate. We talk about a wealth gap and just the difference between the smart money and the public and how they invest and how they trade in the markets, right? The public typically jumps in without the knowledge or the skill. And the institutions or the smart money, they've been educated on that. Now, when we talk about how the smart money is creating income in these financial markets, they're doing something different. So let's talk about that. What are some of the things or the techniques and the concepts that the smart money is using? I mean, now think about this. This is also available to us. So let's talk about that.
Yeah, well, you mentioned that the smart money is already educated. They not only do they know what's going on, but they actually are responsible for moving the price of these markets and individual assets. So it really is important not to try to figure this. You don't have to try to figure it out on your own. Just do what they're doing. Fortunately for us, they telegraph things. And this is the key. Virtually every significant price action or move is telegraphed by these banks or institutions. That's why it's so important to know where and when that action happens. The institutions, that's the smart money, the big firms, the Wall Street firms, the hedge fund managers, they're not going to buy at the top and sell at the bottom. Only amateurs do that. So who do you want to follow, an amateur or the people that are doing this on a consistent basis? And what that means, to be consistent, it means not only participating in the market part of the time when it's going up, for example, because the market does pull back. It does come back. We do have corrections, 10% drawdown or more. We have bear markets, which is a 20% drawdown or more. And the institutions are participating profitably in those moves, and we have the opportunity to do the same thing.
And you just kind of had me, I thought about something. You said that institutions, they buy low and sell high. That's how the public says they trade and invest. Mm-hmm. But how does the public typically buy and sell? They wait for price to go up. They wait for good earnings, good balance sheet, basically everything doing well. By the time all of that happens, price is already up. So, unfortunately, the public typically does it the wrong way.
Right. And that gets back, that's urgency again, urgency of when to get in. And that's what I mentioned. The institutions are telegraphing that to us. But what they're going to tell the public is if they take a large position. For example, Warren Buffett a number of years ago put together a 64 million share position in IBM stock. And he had to do it in increments because IBM only trades 3.5 million shares a day. So he did it incrementally over the course of 7 or 8 months. When did he tell people he was investing in IBM? After he had all 64 million shares put together. And that's typically what happens. The institutions will tell you what they're doing after they've done it. And that means that you've missed a good part of the run-up that they have created. And all of this should be part of a plan. All of the activities that you are involved in, it should be part of an education plan, a trading plan, and that we help all of our students to develop. That plan really becomes a roadmap for you. It's sort of like the GPS systems that people use. I mean, people are so accustomed to using their phone, for example, now, or the GPS in their car. A lot of people couldn't even get out of their driveways if their GPS systems went down.
That's unfortunate, Al.
No, but it's true. So look at this as a GPS system. Where are you now? Are you in your driveway? Where do you want to go? You want to end up in Tampa, Florida? Well, the GPS system will help bridge the gap between where you are now and where you want to be. And that's what a trading plan should do too. Really, the goal there should be to reduce the confusion and the feeling that this is too complicated, which a lot of people accept as fact, which it isn't. As much as possible, simplify the trading and investing process and keep your emotions contained or controlled. That's really important. And that, as human beings, we are born with emotions that are going to be enemies to us in trading and investing. They may help us in our everyday life, but you need to control those emotions. And the way you do that is to have a plan that includes a strategy that is a rules-based strategy. It's a step-by-step process that, as much as possible, takes your thinking out of it, because that's what's going to get you in trouble.
That's funny you mentioned Buffett, that example there. I was actually having a conversation with a good friend yesterday, and we were talking about the financial markets, and he was like, so-and-so is buying this stock, and so-and-so is buying that stock. And I asked him, I said, think about this. Do you think that they're going to be telling you when they're going to buy? they want price to go up, right? Well, they're probably going to buy it and then tell the public, right? So he's like, you know what? That actually makes a lot of sense, and that the public the novice just doesn't understand that. So you were mentioning telegraphing. When institutions or Buffett or the big money is placing these big buys in the markets or sells, they telegraph, which leaves a footprint in the chart. And I want you to kind of explain that in supply and demand terms coming up, but they leave a footprint. So essentially, we want to identify that footprint, which is what the core strategy will help you do.
Exactly.
And then trade like those institutions or the smart money. So if you want to learn more about how the smart money is leaving those footprints, but also how to start your process to potentially identify that, Al, you talk a lot about that in these investing classes. Al, let's continue to talk about, we really talked about in the first segment about these down markets.
Correct.
Let's talk about how that works. How do you participate in down markets?
Yeah, well, number one, accept the fact that the markets will go down at times, and sometimes it can be for a number of years before it really reverses direction and goes back up again. And oftentimes when we have bear markets, it can be 5 or 6 years peak to peak. In other words, if you had a large investment one year, it may take 5 or 6 years after a bear market is hit just to get back to where you were before. The institutions are not sitting on the sidelines and losing money or not having the opportunity to participate in that. They're using strategies that actually will benefit them in a down market. And they're not any different than the strategies that we can use. One is shorting. We talk about that a lot, and we go into more detail in the classes. But basically, shorting is doing the opposite of what you normally do. Typically, if you're going to buy a stock, you buy a number of shares to open that position, and then hopefully it goes up in value, and you sell to close and reap your profit. When you're shorting, you're doing the opposite. You're selling to open a position, but you're selling something you don't own. A brokerage firm is loaning you basically somebody else's shares that you sell. Now, since you have borrowed them, you have a commitment at some point in time to return them. Hopefully, and this is your goal, the value of it goes down, and then you buy it back at a lower price and return it. So you sold it at a high price, bought it back at a low price. That's shorting.
It's just the total opposite. If you think about it, if you're looking at a chart, you are just, flip that chart over.
Exactly.
That's kind of all it is.
No, exactly. And there are many opportunities in these markets to be able to do that. That's only one way of participating in these down markets.
Well, you almost said it.
I did. Yeah. Well, options are another way of doing it, and options can be used to participate profitably, hopefully, in a down market. I mean, that's the opportunity that's there. They can be used to protect your portfolio, and then also inverse exchange-traded funds, inverse ETFs, which go the opposite direction of something. If it's an S&P 500, inverse ETF. If the S&P 500 is down, that ETF will go up in value.
So are you saying the ETF is like a basket of stocks, right?
It is. It's similar to a mutual fund in that it is a basket of stocks, but it trades on the exchanges like a stock. So you can buy and sell it during the day, unlike a mutual fund.
Exactly. You kind of took the words out of my mouth there.
Oh, I'm sorry.
Once again, you do that.
Sorry. You got to let me know if you have a little bit of thunder you want to insert. Let me know that. I'll stay away from it. But that's true, and that's important to know. Because a lot of people, that is the investment they're in, is mutual funds, and they don't realize that you cannot buy or sell during the day. So if you see something significant happening in the market, you're sitting on the sidelines. You can't make a change until the end of the market day when everything is figured out. The value of everything in that mutual fund is figured out. So inverse ETFs is a way of participating in a down market, options, and then also shorting. You can't short in an IRA, by the way, but you could do the inverse ETFs. You can do options. You also can sell. There are a couple of other assets that our students learn: the futures market, the foreign exchange market. Those can be sold to benefit in a downward moving market also. So there's a number of things that we can do that the institutions are doing, but they're just basically not telling their clients about it.
It's amazing that they don't tell people because they want to control the markets. I mean, the public is trained and conditioned. Now think about this. We're told from a young age, find a money manager, find a broker, find somebody basically a stranger to control your financial future. And we're seeing a lot of people that are coming to these investing classes. We talk to several people every single week, and they want more control. They don't want to have a stranger manage their portfolio or their financial future. And it takes a little bit of action, and it takes a little bit of knowledge. Then you have to gain and build a skill. It's just like anything people have done in their